Welcome back to the Deep Dive. Today we are diving deep, really focusing our attention on what you could call the absolute core engine of financial markets, liquidity.
Yeah, absolutely.
And this isn't just about, where some orders might be sitting. It's digging into the institutional blueprint, right? The real mechanics of market movement.
That's exactly it. We're dissecting buy-side liquidity, BSL, and sell-side liquidity, SSL. Now, for anyone who's looked into institutional trading or maybe smart money concepts, SMC, often linked with ICT.
Right, those acronyms?
Exactly. These terms, BSL and SSL, they're completely foundational. Our mission today is really to cut through the jargon, get past just the names and give you actionable, detailed knowledge about why price actually moves.
And maybe even more crucially, where it's likely headed next.
Precisely, where it's practically guaranteed to go if you know what to look for.
Okay, so let's set the stage. Define these gravitational targets, as you put it, BSL and SSL. They're basically massive pools of orders just sitting there.
Huge pools, yeah. Think of BSL buy-side liquidity as this magnetic force sitting just above key swing highs.
Okay.
That area is just packed. It's got stops from short sellers, people who got in near the top and are trying to protect themselves.
Those stop losses, yeah.
And it also has pending buy limit orders from breakout traders hoping the price keeps going up. So when price finally pushes into that BSL zone, boom, it provides this enormous wave of counter-selling liquidity.
Which the big institutions need.
Exactly. They need that wave of selling so they can initiate their own massive short positions without moving the price too much against themselves initially.
Got it. And SSL is just the flip side, below the lows.
The perfect mirror image, yeah.
Huh?
SSL is that cluster of cells stopped sitting just below critical swing lows. So if you were bullish, you bought at what looked like solid support.
Your stop loss is probably tucked right underneath that low.
Right where everyone else's is too.
Yeah.
And that collection, that massive pool of sell orders below the low, it creates the perfect target zone for institutions who want to accumulate large, long positions.
So we have to see these BSL and SSL pools as the fuel. The essential fuel.
Absolutely essential. Institutions aren't just pushing price around randomly. They move it specifically to get into or out of these enormous positions. And they can only do that efficiently by triggering and absorbing all the orders resting in these obvious liquidity pools.
Okay, so why is this institutional view of liquidity so critical? Why does it basically dictate where price goes?
I think we have to start with that core philosophy of smart money, which is, let's be honest, a little cynical.
It is, and you really need to internalize this to understand the game.
Yeah.
The core idea is pretty stark. If you don't know where the liquidity is, well, then you are the liquidity.
Ouch.
It's not meant to be a level playing field. The way price behaves, especially around those really obvious technical levels everyone sees on the chart, it's often interpreted by SMC traders as a series of, frankly, intentional traps, set specifically for the retail trader who doesn't see the bigger picture. That sounds pretty intense. I mean, is it really intentional manipulation? How much evidence is there for that versus, just the market naturally needing to find orders to fill big positions? How do we know it's a trap?
It's kind of both, really, but the intent comes from the necessity. Think about it. When a massive institutional fund, a big bank, a hedge fund, needs to buy, say, billions worth of an asset.
They can't just click buy.
No way. If they did, the price would just skyrocket instantly against them. They get a terrible average price. So they absolutely need an equally massive pool of opposing orders, sell orders in this case, to fill their huge buy order at a price level that makes sense for them.
And where are those sell orders conveniently located?
Exactly where retail traders put their stop losses and their sell stop breakout orders if they're trying to short a breakdown. Clustered right below those obvious lows, that's the SSL.
Ah, okay. So the move down to take out the previous low isn't just some random dip or correction. It's a necessary step for the institution to gather enough sellers so they can enter their big long position. The market has to hunt those stops.
It absolutely has to. The sheer need for counter orders guarantees the market will gravitate towards these BSL and SSL zones. And if you look at where these zones form, it's always at the most obvious places for retail traders. Double tops, triple bottoms, those clean trend lines everyone draws.
Yeah, the textbook patterns.
Textbook patterns, exactly. And most commonly, just obvious swing highs and swing lows. The easier a level is for the average trader to spot, the higher the probability that a massive concentration of stops and pending orders is sitting right there, ripe for the picking.
Okay, that makes sense. And this leads into distinguishing between the targets that are very likely to be hit soon versus those that kind of define the bigger picture trend. You mentioned weak versus strong highs and lows.
Yes, that distinction is critical for setting realistic targets. Liquidity tends to be targeted preferentially at what we call weak highs or lows. Now, a weak high or low is basically one that looks vulnerable. It's likely to be taken out if the current main trend continues.
Can you give a quick example, like in an uptrend?
Sure, so imagine the price is clearly moving upwards overall, makes a little pullback, consolidates a bit, and starts moving up again. That recent little peak it made just before the pullback, that's usually considered a weak high.
Why weak?
Because the overall bullish momentum, the main trend, strongly suggests that price is very likely going to push through that high to grab the buy-side liquidity resting just above it. It's seen as a low resistance level in the path of the trend.
Okay, and conversely?
Conversely, the swing low that initiated that most recent push higher,
Yeah.
that would generally be considered a strong low. The current bullish structure kind of depends on that low holding. Taking it out would signify a much bigger potential shift.
So in an uptrend, weak highs are likely BSL targets. In a downtrend, weak lows are likely SSL targets.
You got it. And then we layer on top of that the time frame context. Where are we within the bigger picture? This gets us to internal versus external range liquidity.
Right, IRL and ERL.
Correct. External range liquidity, ERL. Think of that as the big boundaries, the major swing high and the major swing low that define the current overall playground on your higher time frame chart, like the daily or the 4-hour. These are the big defining peaks and valleys.
And all the price action we see day to day, wiggling around inside those big boundaries.
That's where the internal range liquidity, IRL, resides. It's the liquidity built up within the pullbacks, the consolidations, the minor highs and lows formed inside that larger ERL range, maybe little lows formed during an accumulation phase before the next leg up.
Okay.
And here's a core concept for how the market often operates. It constantly moves between these two. It will frequently sweep or absorb liquidity from the internal range, the IRL.
Like grabbing fuel.
Exactly. Grabbing fuel from the IRL to power the major move towards the external range, the ERL targets. So if you can identify the likely ERL target, you know the ultimate destination. And if you spot IRL getting swept, that's often the signal that the engine is refueling for that journey.
Okay, so if we accept this premise, that the market is actively hunting liquidity and setting traps, then our job becomes understanding the actual mechanics of the trap. How does it work? When institutions target DSL or SSL, what happens next? You said there are two main outcomes, a sweep or displacement.
Yes, and knowing the difference is absolutely crucial. These two define everything that happens after liquidity is engaged. One signals a likely reversal, the trap springing shut, while the other signals powerful continuation.
Let's start with the trap itself, the liquidity sweep.
Right. A liquidity sweep, sometimes called a liquidity run, is the classic manipulative move. Price intentionally pushes just a little bit past that key BSL or SSL level, let's say, just below an obvious swing low.
Just enough to trigger the stops.
Just enough. It hits all those resting stop losses and maybe some pending sell stop orders from breakout sellers. But here's a key. The move immediately reverses, often quite sharply, right after grabbing that liquidity. This is the classic fake out. In SMC language, this specific action is often called inducement.
Inducement. Okay, that word feels right. The market is baiting you, luring you into a bad trade right before the real move. I definitely remember when I was starting out, I lost count of how many times I bought what looked like a perfect double bottom breakout, only to watch the price slam back down like 15 seconds later. That's when you feel like you were the liquidity.
That is exactly the feeling. And inducement is central to this whole framework. If you see a really clean, obvious retail pattern forming like perfect double top that everyone can see.
Smart money knows where the stops are.
They know exactly where the buy stops are clustered just above those highs. So they'll run the price just high enough to trigger all that BSL, filling their own massive short orders against those stops. And then the real move down begins, often immediately and aggressively. You were induced to buy the breakout right when they were selling.
Okay, so that's the sweep, the fake out, the inducement. What about the other outcome? When the move isn't a quick reversal?
That's displacement. Displacement is the polar opposite of a sweep. It's a really strong, energetic, committed push through market structure, through that BSL or SSL level, with obvious conviction and speed.
It doesn't look hesitant at all.
Not at all. Displacement often leaves behind significant gaps or inefficiencies in price action. We call these fair value gaps or FVGs, and we'll definitely dig into those later. Displacement signals that the institution didn't just grab the liquidity, they used it to fuel a powerful continuation. They're now aggressively committed to the new direction, heading towards the next major BSL or SSL target.
What's really interesting here is how these, quite modern-sounding terms, sweeps, displacement, inducement, actually map almost directly onto much older market analysis concepts, specifically the Wyckoff method, right?
Absolutely, and that connection is so important because it shows these aren't new phenomena. They're timeless market mechanics just described with different language. Many core SMC ideas are really just modernized, perhaps more precisely defined, versions of Richard Wyckoff's observations of accumulation and distribution cycles from nearly a century ago.
Okay, so let's draw the parallels. How does a liquidity sweep below support, grabbing SSL, relate to Wyckoff?
A sweep below support, that SSL hunt, is almost perfectly analogous to what Wyckoff called a spring. In his model, during an accumulation phase where institutions are quietly buying, the price will often make a final sharp move down below the established support range.
To shade people out.
Exactly. It shakes out weak hands, traps eager short sellers, and triggers the stop losses of early buyers hitting that SSL pool. But critically, strong institutional buying absorbs all that selling pressure at those lower prices. Once the stops are cleared and the selling pressure is exhausted, the price springs sharply higher, often marking the end of the accumulation phase. The trap is sprung, the liquidity is taken, and the real move up begins.
And the opposite, the sweep above resistance, hunting BSL.
That maps directly to the Wyckoff upthrust. Same idea, but during a distribution phase where institutions are selling, price makes a sharp thrust above the established resistance range. This tricks breakout buyers into entering long, and it triggers the stop losses of short sellers hitting the BSL pool.
Providing the liquidity for institutions to sell into.
Precisely. It provides the necessary buy-side liquidity for them to unload their large positions or initiate massive shorts. Then the price immediately fails, reverses sharply downwards, often signaling the end of the distribution phase. Wyckoff described these actions vividly, things like false the direction to ventilate stops, they grab the fuel, then go.
Okay, so practically speaking, when we see one of these sweeps, a spring or an upthrust, happen in real time, what's the confirmation we look for? What tells us the trap worked, and we can now consider trading in the opposite direction?
Good question. We typically look for what's called a change of character, or often just abbreviate it to CHOCH. We'll define this more precisely later, but the basic idea is this. After the sweep happens,
The market needs to immediately and decisively break a key internal structure point in the opposite direction of the sweep. So, if price swept below a low, SSL spring, and is reversing up, we need to see it break the most recent internal swing high with some energy.
and if it's swept above a high, BSL upthrust.
Then we need to see it break the most recent internal swing low with energy as it reverses down. That break, that shoch, is the confirmation. It shows that the liquidity grabbed during the sweep has now successfully fueled the move in the opposite direction. If the sweep happens, but price just kind of flounders and fails to break that internal structure point.
Then the sweep might have failed.
Exactly. The manipulation might not have gathered enough force, or the underlying trend might just be too strong, and price could continue towards the next liquidity pool in the original direction. The confirmation is that immediate aggressive break of internal structure right after the sweep. Okay, understanding the sweep, the manipulation, that really confirms the why behind these moves. Now, let's get practical about the where. How do we actually forecast which BSL or SSL pool is the next likely target with some degree of confidence?
Right. Forecasting the target. We generally use a three-pronged approach here. We need a directional bias, we need a sense valuation, and we absolutely need to consider time.
Okay, let's break those down. First up, daily bias.
Daily bias is paramount. Before you even think about an entry, you need a high time frame perspective. What's your overall expectation for the day or even the week? Are you generally looking for higher prices, bullish bias, or lower prices, bearish bias? You have to establish this first, usually by looking at the daily or 4-hour chart structure.
And getting that bias right immediately tells you which side of the liquidity coin, BSL or SSL, is the primary magnet for that day.
That's exactly it. If your analysis suggests a strong bullish daily bias, then your primary objective for the session should be BSL, usually located above recent highs or maybe the previous day's high.
Which means you should probably avoid taking short trades, even if they look okay on a smaller time frame.
Absolutely. If the big picture, the institutional flow, is clearly aiming higher towards BSL, taking counter-trend shorts is fighting a strong current. It dramatically lowers your probability of success. You should be actively hunting for opportunities to get long, aligned with that underlying push towards buy-side liquidity. Trading against the higher time frame bias is a tough game.
Okay, bias first. Number 2 was valuation, making sure we're not buying at the top or selling at the bottom of a move. This is where premium and discount zones come in.
Yes, this is a crucial filter for entry quality. What we do is identify the current relevant dealing range. This is usually the range from the most recent significant swing low up to the most recent significant swing high on your main operating time frame, maybe the 1 hour or 4 hour.
And how do you define significant? Is it just the absolute highest high and lowest low you see?
It's typically the range that created the most recent break of structure or led to a significant impulsive move. It's not always the absolute highest high and lowest low on the screen, but the range that seems to be currently governing price action. And once you have that low and high defining your range,
You split it in half.
exactly, you draw a 50% line, the equilibrium point, right in the middle of that range. Anything above that 50% line is considered premium. It's expensive relative to the current range.
And below is discount.
Anything below the 50% line is discount. It's cheap.
And the core strategy here is pretty simple, right?
Dead simple, but incredibly effective. Always aim to buy when the price is in a discount zone below 50%. And always aim to sell when the price is in a premium zone above 50%.
Okay.
This automatically helps you avoid chasing moves. It ensures you're entering at a potentially advantageous price relative to the market's current perceived value range. And think about targets. If you're aiming for a BSL target way up high, that target logically needs to be deep within a premium area, right? That's where you'd want to sell your longs when it's expensive.
Makes sense. And SSL targets should be deep in discount.
Precisely. You want to buy back your shorts when the price is cheap, deep in that discount zone where SSL pools often reside.
Okay, bias and valuation. The third piece, and you said this might be the most powerful for day traders, is time. Time-based liquidity targets.
Oh, time is absolutely non-negotiable for intraday traders. Institutions very frequently engineer their big moves, their liquidity hunts, around specific, predictable time structures. The most obvious ones are the previous day's high, PDH, and the previous day's low, PDL.
Always key levels.
Always. These act as incredibly reliable BSL and SSL targets. If the market has a clear bullish bias for the day, you can almost bet that the previous day's high, PDH, will be challenged or taken out before the session ends. They are natural magnets.
And then you have the weekly high and lows, which obviously carry even more weight, representing a whole week's worth of order buildup.
Exactly. Those are major targets for longer-term swings. But for the day-to-day action, we zoom in even further and focus on kill zones. Now, kill zones aren't necessarily times of highest volume, but they are specific windows of time known for high activity specifically, institutional manipulation like sweeps, and then often the subsequent distribution or directional push.
Okay, which times are we talking about? What are the main kill zones?
The first key one is the London session kill zone. This is roughly 1:30 a.m. to 4:30 a.m. New York time. London is very often characterized by manipulation. It frequently sweeps the high or low of the preceding Asian session or maybe engineers a move related to the weekly open price early in the week. It often sets the stage, creates the trap.
It does the dirty work, maybe.
Kind of, yeah. It engineers the inducement. But then, arguably the most favored time for finding high-probability setups, especially for U.S. traders, is the New York AM session. We really want to focus intensely on the window from about 9:00 a.m. to 10:30 a.m. New York time.
Right after the New York Stock Exchange opens. Why is that specific 90-minute window so consistently important?
Well, a couple of reasons. First, the New York Open brings in the highest trading volume of the day globally. But more importantly, it's when the major U.S. banks, funds, and institutions really become active. So if the London session performed the manipulation, the sweep, the inducement,
New York executes the real move.
often, yes. The New York AM session frequently executes the primary directional move for the day, the distribution phase, as Wyckoff would call it. This is often the true committed push towards those major external range liquidity targets or the key time-based levels like PDH or PDL. If you can really focus your attention and look for confirming setups within this specific 90-minute NY window, you can significantly improve your strike rate and trading efficiency.
All right, so we've got the location of the fuel, BSL, SSL. We have a good idea of where the market's headed using bias, premium discount, and these time-based targets. And we know when the action is most likely thanks to kill zones. Now, let's bring in the specific SMC tools people use to actually pinpoint an entry. Let's start with order blocks, or OBs.
Order blocks, yeah, they're fundamental structural reference points in SMC. An order block is typically defined as the last candle, or sometimes a small series of candles of the opposite color, right before a very sharp impulsive move, a displacement.
The kind of move we talked about earlier.
Exactly. A displacement move that either breaks market structure, like takes out a previous higher low, or ideally, a move that clearly takes out liquidity, sweeps BSL or SSL.
Okay, so what's the underlying logic? If BSL SSL is the fuel, what's the best way to think about an order block? Is it like a launch pad? A pause?
I think a good analogy is an institutional staging area. Or maybe even better, think of it as a point of financial commitment or even temporary debt for the institution. Let me explain that.
Okay.
When a huge institution wants to get into a massive position, let's say they want to buy big, they might intentionally place a part of their order, let it go slightly underwater for a moment. They accept a small temporary loss on that initial piece
Why would they do that?
to help manipulate the price down, maybe to sweep some SSL below a low, trigger stops, which allows them to then fill the rest, the much larger portion, of their buy order at a significantly better, lower price. The order block often represents that initial point of entry, the zone where those first temporarily losing trades were placed. These are sometimes called mitigation trades.
Mitigation. Okay, let's pause on that word. What exactly does it mean for an institution to mitigate a position in this context?
Mitigation, in this sense, means basically offsetting or clearing a financial liability or exposure. When price eventually returns back down to that original order block where they initially bought, it's often because the institution needs to revisit that specific price level to close out or financially neutralize those initial underwater entry contracts they used for the manipulation.
Ah, okay.
Yeah.
So they close out the small losing part of the trade at roughly break even.
Exactly. Once those initial debt positions are cleared or mitigated at the OB, the institution is now financially clean and free to let the main, larger position run strongly in the intended direction towards that major BSL or SSL target without carrying that initial baggage.
So the order block becomes this level price, often needs to revisit, like a quick pit stop, before the main institutional trend can really resume.
That's a great way to think of it, yeah, a pit stop for mitigation. And crucially, a high-quality order block, one that's likely to hold, is almost always preceded by a very clear liquidity sweep just before its formation.
That confirms the manipulation happened.
It verifies the move wasn't just random, it was intentionally fueled by grabbing stops. And here's a key filtering tip. You have to be careful which OBs you trust. An order block is much, much less likely to be respected if there's obvious, untaken liquidity, like a clean SSL pool below a bullish OB, or clean BSL above a bearish OB sitting right nearby.
By that.
Because the market will almost always go for the easier, more obvious liquidity first. It's more likely to break right through that order block to grab the nearby SSL BSL before potentially reacting later. So context is everything.
Okay, OBs make sense. Next up, breaker blocks, or BBs. These sound related, maybe like order blocks that didn't work.
That's actually a pretty good way to frame it initially. A breaker block occurs when a specific price level, often it was a valid order block, or maybe a clear supplier demand zone, it fails to hold price as expected. Instead, price breaks right through it, usually with that strong displacement we talked about. And then the polarity of that level completely flips. For example, imagine a bullish order block that should have acted as support and held price up. But price slices right through it downwards, when price later retraces back up to retest that same level from below.
That old support becomes new resistance.
Exactly. The order block broke, and now it acts as a breaker. Its function has inverted.
So the breaker block acts as a confirmation that the structure has genuinely shifted.
It really does. It often marks the official shift in momentum, the confirmation that the tide has turned. Breaker blocks are incredibly powerful signals because they very often form immediately after a major liquidity sweep like price sweeps, BSL above a high, fails to continue up, then breaks down through a previous bullish OB, forming a bearish breaker. That sequence signals the market's strong commitment now to push towards the opposing liquidity pool, SSL in this case. It confirms the initial manipulation, the BSL sweep, has successfully transitioned into a validated new trend downwards.
Got it. Order blocks, breaker blocks. Finally, the visual signature of that strong displacement move. Fair value gaps, or FVGs.
FEGs, also known sometimes as imbalances or inefficiencies. These are usually pretty easy to spot on a chart. It's typically a three-candle pattern where there's a gap between the wick of the first candle and the wick of the third candle.
Meaning the second candle moved really fast.
Exactly. The body and wicks of the middle candle shoot up or down so quickly that they don't overlap with the wicks of the candle before it and the candle after it. This leaves a visible void or gap in price action on the chart. That gap is the FEG, and it's the direct result of that fast, one-sided, aggressive push, the displacement.
And why are these gaps important? Why do we care about them?
Because, conceptually, the market tends to seek efficiency or balance over time. When a large FEG is left behind by a rapid move, price has a very high probability, a strong tendency, to eventually return back into that gap to fill it or rebalance the price action within it.
Before continuing in the original direction.
Often, yes, before continuing its move towards the major BSL or SSL target it was heading for. So these FEGs act like little magnets for price during short-term retracements or pullbacks. They often provide very precise entry points, especially when they align with other key levels like order blocks or breakers within those premium or discount zones we discussed.
Is there a type of FEG that carries more weight, like signals stronger institutional intent?
Yes, definitely. You want to look out for what's sometimes called a break-in structure gap, or maybe a BDI, buy-side imbalance, sell-side inefficiency, or CB for the sell-side version. Essentially, this is an FVG that is created as part of a displacement move that doesn't just push price along, but actively breaks through significant prior market structure, like taking out multiple previous swing highs or lows in one aggressive push.
So is an FEG formed during a major structural break?
Correct. That type of FEG carries a lot more weight. It's a powerful confirmation of strong institutional commitment and intent to continue hunting towards the next major BSL or SSL target. It's a sign that serious capital is driving the move.
Okay, we have the full toolkit now. We understand the targets, BSL, SSL, the manipulation sweeps, the context, bias, PD zones, time, and the tools, OBs, BBs, FEGs. The final critical piece is putting it all together. How do we translate all this knowledge into an actual high-probability trade entry? How do we make sure we're genuinely trading with the smart money and not just, taking a punt?
Right, execution. High probability entries demand, absolutely demand, confluence. You need multiple factors, multiple pieces of evidence lining up together. You can't just trade off one signal in isolation.
So what are the key confluence factors?
I'd say the most critical are alignment across time frames, the specific time of day, kill zones, and clear structural confirmation on your entry time frame. And that first one, alignment, is non-negotiable.
Tell us more about alignment. What needs to align?
Your higher time frame, HTF, say the 4-hour or daily chart, this dictates the overall narrative, the ultimate BSL or SSL target for the current swing. Maybe it's targeting the weekly high, BSL. If that HTF picture is clearly bullish,
Then your entry time frame has to agree.
exactly. Your lower time frame, LTF, maybe the 15-minute, 5-minute, or even 1-minute chart where you're looking for the precise entry must also show confirming bullish structure or signals. If the 4-hour chart is screaming go long to BSL, but your 5-minute chart is still making lower lows and lower highs, you wait.
You wait for the little picture to match the big picture.
Precisely. You're waiting for the LTF to shift, to break its bearish structure and align with the higher time frame's bullish intention. Entering before that alignment happens is just jumping the gun.
Okay, so let's make that concrete. Say price sweeps the previous day's low, PDL, grabbing SSL. We're now expecting a reversal upwards based on our HTF bias. What specific pattern on, say, the 1-minute chart would confirm the reversal is happening and give us the green light?
That's where the change of character, chouch, comes in again. After price sweeps the PDL, the SSL hunt, and starts to reverse upwards, we need to see it decisively break the most recent clear internal swing high on that 1-minute chart, preferably with some displacement, maybe leaving a small FEG.
That break is the choach.
That break is the chouch. It's the first signal that the immediate short-term downward flow has been broken, and the structure is potentially shifting bullish, aligning with our expectation after the SSL sweep. That choach confirms the trapped selling pressure below the PDL is now likely fueling the move up.
And after we see that choach, where would we actually look to enter the long trade?
Good question. You typically don't just chase the price after the choach. You wait for a slight pullback. You'd look for price to retrace back down to potentially test a newly formed bullish order block that was created during the move that caused the choach. Or another very common entry point is an inverted FVG.
Inverted FEG.
An
What's that?
an inverted FEG is simply a fair value gap that initially formed during a down move, so it was a potential resistance area for shorts, but then price forcefully pushed up through it during the reversal in the choke. Once price breaks above it, that FEG inverts its polarity flips, and it now often acts as a sensitive support zone for potential long entries on a pullback. Often these align nicely within the discount zone of the immediate range.
So the key takeaway here is you can't just spot any old order block on a 5-minute chart and trade it randomly. It needs context.
Absolutely not. That's a recipe for disaster. These confirmation patterns, the choke, the tap into a confirmed OB, the retest of an inverted FEG, they must occur at or very near a significant higher timeframe key level. That could be the PDL-PDH itself, a major HTF order block, or perhaps within a specific kill zone time window. Trading these LTF patterns in the middle of nowhere, with no HTF context or confluence, that's just gambling, not strategic trading.
Makes sense. Let's talk about getting out of the trade. Setting objective take-profit targets seems crucial with this method.
It is. And the most objective, logical way is to target the opposing major liquidity pool, especially time-based liquidity. If you entered long after a confirmed sweep of SSL below the PDL.
Your target is likely BSL.
Exactly. Your primary target should probably be the previous day's high, PDH, or maybe the high of the Asian session if that's relevant, or the next clear pool of BSL visible on the higher time frame chart. Remember, the market is fundamentally driven to move from one major liquidity pool to the next. Don't try to fight that natural gravitational pull when setting your main target.
Okay, but what happens if a setup looks good, you enter, and then it fails? Like the order block you bought from gets smashed through. Flexibility seems really important here.
Oh, absolutely critical. The market is constantly giving you information. If a key level fails, say, that bullish order block you entered long at gets decisively broken downwards with displacement, maybe even leaving a new bearish FVG behind.
Market's telling you something.
It's screaming at you that your initial bias was wrong, or at least the timing was off. You cannot be stubborn. You have to immediately reassess. Look for where the next logical liquidity pool is in this case, probably further down, SSL. Be prepared to ditch your original idea and potentially even flip your bias and look for shorts. Flexibility and the ability to admit you were wrong quickly are essential survival traits.
That leads perfectly into risk management. Given the potential for sharp reversals and failed setups, managing risk has to be absolutely watertight. All right. What are the non-negotiables?
Absolutely non-negotiable. First, especially when you're starting out or transitioning to live trading with the style, keep your risk per trade incredibly low. If you're trading futures, start with micro contracts, not minis. If Forex or stocks, use very small position sizes, get comfortable with the mechanics, and build confidence without risking significant capital. Keep the dollar amount risk per trade small enough that it doesn't trigger emotional responses.
And managing risk on a daily basis.
Yeah.
Any hard rules?
Yes. Implement a strict daily loss limit. A common and highly disciplined rule is stop trading for the day after 2 consecutive losing trades. Full stop. No revenge trading.
Okay.
Alternatively, some traders adopt a one-and-done approach if they hit a solid winner. If you catch a good trade that meets your target, maybe aiming for 2R or 3R, meaning your reward was 2 or 3 times your initial risk, consider stopping for the day. Secure the win, protect your capital, protect your mental state. This approach, combined with setups that offer high RR, helps ensure positive expectancy even if your win rate isn't super high.
What about managing trades once they're actually in profit? A lot of people struggle with getting stopped out at break-even by just a tiny wick.
Yeah, the dreaded break-even stop out. That's where trimming or taking partial profits can be really effective. It's often psychologically easier and potentially more profitable than just slamming your stop to break even too early.
How does trimming work?
When your trade hits a logical first objective, maybe it reaches 1R profit or clears a significant internal high-low, you close out a portion of your position, say 50%. You bank that profit.
So you've secured some gains.
Exactly. You've taken money off the table, reduced your overall risk on the trade immediately, often to 0 risk or even guaranteed profit, depending on how much you trim and where your original stop is. And importantly, it allows you to leave the remaining portion of your position on with the original stop loss, giving it maximum breathing room to potentially run all the way to that final major BSL or SSL target without the constant fear of getting nicked out by noise around your entry price. #tag outro.
Wow, this has really been a deep dive, hasn't it? We've effectively charted the hidden currents, the institutional flows of liquidity, and hopefully made it clear that these BSL and SSL pools are, well, almost unavoidable gravity points that dictate so much of the market's direction.
Yeah, I hope that came across. Once you can identify those key liquidity pools and, crucially, start to recognize the common institutional manipulation tactics, those sweeps, those inducements, you really can fundamentally shift your perspective.
How so?
You move from being the unaware retail trader who's constantly getting caught in these traps, becoming the liquidity, to potentially trading alongside the smart money. You start using their own structural traps, like seeing that choke confirmation right after a clear liquidity run as your actual signal to enter.
So wrapping this up, what's the main thing we want you, the listener, to take away from all this?
I think it's understanding that fundamental drive. All the tools we talked about, the order blocks, the breakers, the FVGs, the choke, mitigation, premium discount, kill zones, they're all just components. They exist only to help you identify and execute a high probability trade that targets a major BSL or SSL pool, validated by time and higher time frame context. It all comes back to that hunt for liquidity.
And maybe a final thought to leave people chewing on.
Yeah, consider this. Now that you hopefully understand this fundamental market-wide mechanism, this relentless drive from one liquidity pool to the next, think about how many other trading strategies or methodologies you might come across. How many seem incredibly complex, with fancy proprietary names and indicators? Ask yourself, are they really showing you something new? Or are many of them perhaps just putting new labels, maybe unintentionally, on this very same core process of identifying and reacting to BSL and SSL manipulation? The terminology changes, but the market's core function, finding that fuel in the stops, seems pretty constant. Go look for the fuel.